I'm Angeline Ong and welcome to Beat the Street, a show that gives you all the tradable news and data you need to know ahead of the Wall Street Open. Coming up, stock slide in pre-market as investors eye higher for longer Fed rates. Speaking of eyeing, we're waiting on those factory gate numbers. They're in focus after softer CPI numbers. Plus, the robotaxi gets the nod. Full taxi service 24/7 will be available soon in San Francisco. More details on that story in a moment. Good afternoon, I'm Angeline Ong and welcome to this new edition of Beat the Street. Now, not long before Wall Street starts trading, this is how equity markets are looking. They're looking slightly lower. However, we have got some breaking news just coming through right now, and this is on the factory gate prices. We were looking for 0.7% for the headline figure year on year for July. We got slightly more than that, 0.8%, still very close to what was expected. And we're also expecting, 0.2%. For the month-on-month figure for July, we got 0.3%. So just slightly, ever so slightly higher than what was expected. Still indicating that input cost pressures in the world's biggest economy are softening. And this comes after that CPI figure, which also showed a softening of inflationary pressures. However, there's still this thought that perhaps the Fed might indicate higher for longer to try and keep that inflation beast under control. Now, let's take a look at the volatility index after that data. Prior to the factory gate prices, it was 17.39. It's now 17.58, so just a touch higher. Let's take a look at the US dollar basket as well. Also, that not much of a change. 10.220. Prior to that, it was 10.207. And just checking on the euro dollar for you as well. This has fallen slightly. It was trading at around 11,000. It's now 10,988. Actually, not much of a change either, because those figures were pretty much in line with expectations. Now, ahead of those factory gate prices, IG market analyst Chris Beecham has been taking a bigger picture look at where US indices are heading this week.
US indices are facing a mixed open after what has been quite a disappointing week for Wall Street. Most US major indices are down for the week, with the small caps and the Russell 2000 leading the way with a loss of almost 2% over past 5 trading sessions. The Nasdaq following closely behind with a 1.6% loss. It looks as if this risk-off move could well continue into next week, and with little in the way of earnings to support markets. Investors still seem to be in risk-averse mood as they head into the second half of August.
Thanks, Chris. So that's the picture on the markets. Let's take a look at gold now, because prices there on track for their worst week in 7, hurt by an overall stronger dollar and elevated bond yields as investors look towards more economic data and, of course, digest those easing inflation figures. Well, where does gold go from here, and where are the key levels of support? IGTV's Jeremy Naylor has been looking at what could drive the direction of gold prices into the next week.
Yes, Angelina, I want to set up this trade idea around gold, but I want to look at this from the angle of what's happening in the US dollar. You'll remember that earlier in the week on Beat the Street on Thursday, you broke the news that inflation had come through in the States pretty much as expected. If anything, it was slightly weaker. Yes, inflation did tick up a little bit, but it wasn't as strong as some had feared. Now people are asking the question, just what's going on in the minds of the voting members of the Federal Reserve, because this is all key to what's happening with the dollar and with gold. Before we take a look at those two charts, and gold in particular for a trade idea, I thought perhaps I'd look back to see what Mark Oswald said. He's the chief global strategist and chief economist at ADM ISI. Now, he said yesterday, in the wake of the news about US interest rates and inflation, he said the chances of a further rate hike looks to be on the very low side, but the Fed will continue to bang the drum of higher for longer, above all, given that labour demand remains robust and the economy continues to expand. He says both of these shoes will have to fall If the current market rate trajectory assumes an initial rate cut in March 2024 and a cumulative 150 basis points of rate cuts down to 4% by the end of 2024. Now, I thought I'd look at what's happening with the dollar basket. Let's assume that the Fed has done pretty much all it needs to do in order to continue to see a softening in inflation. Some of the comparatives to last year are going to help this number for sure. There are concerns that inflation will stay around, and it either means the Fed will keep interest rates where they are for longer, or as suggesting perhaps possibly maybe if some of the economic data does show that there is a weakening. Anyway, the trade setup here, not for the dollar particularly, I want to take a look at gold in just a minute, but the dollar has an importance for gold. As we got this falling line of resistance, which we're just up against at the moment. Now, if we see an escape of this, in other words, further upside from where we are at 102.27, this is the dollar basket, the dollar trading against all the major currencies around the world. It's made up mostly of euro-dollar trade, of course. But if we do see an escape of this, you see a candle close beyond this falling line of resistance at around about the 102.50 level. You're then on the way up to this red line here, which is 200-day moving average, which will provide an extra element of resistance. So that kicks in at 103, which also coincides with the high that we had in this market there back on the trade on the 6th of July. Now, that's not my base case. My base case is that we're going to see a continuation of this drop here, and possibly that the dollar's done all it's going to do on the upside. Now, let's take a look at this in the context of what's happening with gold. Let's take my assumption that the dollar has done all the upside it's going to do, and we could well then see the dollar pull back. Now, if that happens, this fib line of support at 61.8% will hold. And in fact, in today's trade, you can see it is holding with this little bit of a green candle. Now, if you're brave and you take a long position on this, assuming that the dollar does fall again, your stop would go underneath the 200-day moving average. Your stop loss at around about the 1900, just below the 1900 level. Let's say 1890 is a good place for your stop loss if you're long on this. That is a bit of a brave trade. I'd want to see 2 or 3 more days of upside before I take a long position here. But if you think there is more to come from the Fed, if you think that there's more upside to go for the dollar, then you'd go with your instincts and wait for a candle close below this line of support here at 1911, and then take your trade on down to the 1870, which is a 76.4% retracement. So I'm unsure as to where the gold price is going to go from here, and it is much dependent on whether or not the price of the dollar breaks through that falling line of resistance. We'll have to see into next week to get a firmer idea, but at the moment at least we're seeing gold hold at this line of support at 1911.
That's a really interesting chart, Jerry. Thanks so much. Another interesting chart that I want to show you is News Corp, because look at it, shares, it's up at around 2.6% after the company beat quarterly profit estimates, quarterly core earnings rising 8%. Let's just have a look at the headlines for you. The total for the core earnings figure was 341 million. Cost cuts also helped, might I add, and the stock is posting its biggest intraday percentage gain, I believe, since May the 15th. Now, I just also want to take a look at Alibaba for you, because Alibaba and JD are both all sessions on the IG platform, and they are slipping. Alibaba there down 2.2%. Let's have a look at JD.com, also an all session stock, slipping around currently 3.8%. This is after investors were disappointed by Beijing's latest stimulus measures. Meanwhile, we had data earlier in the week which showed that the post-pandemic recovery in China was losing steam. And finally, California is now the epicenter of the self-driving car industry. Soon, anyone in San Francisco can hail a driverless car with a few taps of a phone 24/7. Just taking a look at Google, Alphabet, of course, is behind Waymo, and also General Motors as well behind Cruise. Following a contentious state agency vote, Alphabet's Waymo and General Motors Cruise are now allowed to take paying passengers day and night. That's right. day and night throughout San Francisco. The California Public Utilities Commission sided with the companies in the face of vigorous opposition from some residents and city agencies. Some voiced concerns about safety in favor those that felt that driverless cars were safer than humans and would boost the local economy. This vote changes everything from those who stand to gain and take the next step towards turning billions spent chasing this tech and driverless dream to those in AI, to those as well that support all this tech. Of course, let's not forget the others that are affected, namely Uber, which is another all-session stock on the IG platform, and also Lyft, because these two companies offer ride-hailing with humans in the driver's seat. Well, earlier we spoke to Anthony Batista from Tasty Live. I asked him whether or not there was any excitement on the ground following this news in Chicago.
Well, we haven't heard quite the same chatter here in Chicago as they have in California, but we have a wonderful tech incubator here in Chicago, one of the biggest next to California. So my feeling would be if California leans that direction, Chicago will lean that direction also.
Thanks, Bat. And taking a quick look at oil for you, US crude here in particular, because this is after comments from the IEA. They said that OPEC Plus's supply cuts could erode oil inventories in the rest of this year, potentially driving prices even higher. They say that deepening supply cuts have collided with improved macroeconomic sentiment and all-time high world oil demand. Now, before we part, let's have a last look to see how markets are looking after those that reading on factory gate prices, and we are still looking at a cautious open. However, the long-term upward grind is still in play there, although volatility has crept up ever so slightly. And that's it for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the opening bell. For more trading insight, follow me on @IGCom and @Angeline Ong on Twitter. This is IGTV.